The first decision you make as an Innovator Founder Visa applicant sets the direction for everything that follows before you hire anyone, sign a contract, or raise a pound. Choosing the right business structure determines how much of your personal wealth is on the line, which tax regime applies to your profits, and whether early investors can unlock the government reliefs that make backing you attractive. Get it right early, and building the financial model for your endorsement is straightforward. Get it wrong, and you can find yourself locked out of funding, carrying unexpected personal liability, or overpaying tax the rules never required you to pay. In the next 5 minutes, let us map the whole landscape.
UK law gives you 4 realistic options. A sole trader is the simplest. No company's house filing, but unlimited personal liability. Every business debt is your personal debt. A limited liability partnership, or LLP, caps partners' exposure to what they invest, but profits flow through each partner's personal tax return, and critically, LLPs cannot access SEIS or EIS. A private limited company, a limited, is a separate legal person. It limits your personal exposure, pays corporation tax, and is eligible for investor relief schemes. For Innovator Founder Visa applicants, that combination makes it the default choice. A PLC carries the regulatory overhead of a stock market listing, irrelevant at the startup stage. The real decision is almost always limited from day one.
When your company is a separate legal person, your personal savings and home are not automatically on the line if the business runs into difficulty. That is what limited liability means in practice. But for most innovator founders, the second argument is decisive: SEIS and EIS. The Seed Enterprise Investment Scheme gives investors 50% income tax relief on qualifying investments as of the 2026-27 tax year. Always verify the current rate at gov.uk. EIS extends 30% relief to later stage rounds. Both schemes are exclusively available to qualifying UK limited companies. Without an LTD, those reliefs simply cannot be offered to your investors. For a startup seeking angel funding, that single fact often settles the question. The moment you incorporate, you become a director, and that is a legal title with real personal duties attached. UK law requires you to act in the company's best interests, keep accurate records, file annual accounts, submit a company tax return, pay corporation tax on time, and disclose any personal conflicts of interest. You can hire an accountant to manage the mechanics, and you should. But if a deadline is missed, the penalty lands with you, not them. Delegating the work does not transfer the legal responsibility. Building your own deadline calendar, separate from your accountant's reminders, is one of the most practical things a new director can do from day one. Once incorporated, 4 obligations repeat every year. First, the confirmation statement, filed at Companies House within 14 days of your incorporation anniversary. Not a financial document, just confirmation that your directors, shareholders, and registered address are current. Second, annual accounts, filed at Companies House within 9 months of your accounting year end. Third, corporation tax payment, due 9 months and 1 day after year end, paid to HMRC. Fourth, the CT 600 return, filed with HMRC at 12 months. The order catches many first-time directors off guard. You pay corporation tax before you formally file the return. For a December year-end, accounts go to Companies House by end of September, the tax payment to HMRC in early October, and the CT 600 3 months after that. 4 taxes touch almost every UK startup, and confusing who pays which is one of the most common errors in Visa financial models. Corporation tax is the company's own tax on its taxable profits. VAT is collected from your customers on HMRC's behalf and remitted quarterly, net of the VAT you paid on your own purchases. Income tax is your personal tax on the salary and dividends you draw from the company, and national insurance splits in 2. Employee NI is deducted from your pay. Employer NI is paid by the company on top of gross wages. That employer NI is a real payroll cost, separate from and additional to the salary figure itself, and it belongs in every financial projection you build. That registration becomes mandatory when your VAT taxable turnover crosses £90,000 in any rolling 12-month period. That is the threshold as of the 2026-27 tax year. Always verify the current figure at gov.uk. The test is rolling, not calendar year, which means fast-growing founders tracking monthly revenue can cross the threshold without noticing. Once registered, you add 20% to your sales invoices, reclaim the VAT on your business purchases, and pay HMRC the net difference every quarter. The cash flow trap. The VAT element of every customer payment sits in your bank for up to 3 months before the return is due. It is not your money. Opening a dedicated VAT account and moving 20% of every VAT-inclusive receipt into it on arrival is the single most effective protection. Most founder-directors pay themselves through 2 channels, a modest salary and dividends. Salary goes through PAYE, income tax and national insurance apply. The employer NI portion is an additional cost to the company on top of gross pay, not included within it, and it must appear in your financial model. Dividends come from the company's after-corporation tax profits, are taxed at dividend rates, and attract no national insurance at all. The typical approach is a salary at or near the national insurance threshold, then dividends for the rest. One critical trap: the employment allowance, up to £10,500 of employer NI relief per year as of 2026-2027, verify at gov.uk, is unavailable when the sole director is the only person on the payroll. This omission is the most common national insurance error we see in Visa business plans.
Every expense you deduct from taxable profit must pass one test. Was it incurred wholly and exclusively for the purposes of the trade? Both words carry weight. Wholly means no personal element. Exclusively means the purpose was the trade itself, not something alongside it. Salaries, software licenses, accountancy fees, business travel, and company-owned mobile phones typically pass. Client entertaining, personal holidays, gym memberships, and designer luxuries do not. They are disallowed regardless of any business rationale offered. Some items sit in the middle. Company cars and private medical insurance are deductible for the company, but become taxable benefits in kind for you personally. Capital expenditure, equipment, a purpose-built office, is handled through capital allowances, not as a direct revenue deduction. Keep all receipts for at least 6 years. That is how far back HMRC can investigate.
So, choose the right structure from day one. Understand which taxes belong to the company and which belong to you personally. Keep the 4-deadline filing calendar in front of you and treat the VAT in your bank as HMRC's money, never your operating cash. The full guides are in the Financial Fluency series at torlyAI. Run a free assessment while you are there, and when you are ready to plug these figures into a working model, the IPOC Financial Modeler is built for exactly that. This has been educational, not financial advice. Always check current figures and verify your own numbers with a qualified accountant.